Okay, all right. Let's get some perspective in. Hartmut Issel is Head of Equity and Credit Asia Pacific and Chief Investment Officer at UBS Wealth Management. We've got Drew Pettit, Director, US Equity Strategy and ETF Analysis and Strategy Research at Citi, joining in as well. Gentlemen, great to have both of you here. Appreciate it very much. Drew, good to see you back after yesterday. I hope you got some sleep. There are two things I want to get to. One is, so we got a 2.5-3% kind of move on large cap indices overnight in the US. Will equities be able to ignore yields for too long, bond yields for too long? Or you think that'll be an impediment? If yields continue to move higher, equities will have to take notice. And second, is there one more leg higher left if they call the House for Trump as well, and then it actually becomes a sweep? Because they're still saying it's close but leaning Republican. What's your sense?
So right now we're working under the assumption that the Republicans are going to take the House. I think the last probabilities we've seen have actually still remained relatively high. So under that circumstance, yes, yield may stay in focus. And to be honest with you, while short term we could see very elevated levels of sentiment, basically keep the S&P high, maybe push us to as high as 6,100 for this year. Longer run, it's hard to justify multiples, much north of 22, 23 times on the index if we don't see 10-year yields, let's call it 4 or sub 4%. So yeah, to answer the first part of your question, yes, longer run, if yields stay elevated and rate volatility stays high, that does potentially put a cap on upside in U.S. equity markets.
Okay, well, let's see how this plays out. Right now, it's just a roaring rally. Let's take the conversation to Hartmut Issel as well. Hartmut, so the question really is on India from our perspective, because I don't know if we can take a blanket umbrella approach to emerging markets anymore. In terms of, is Trump good for emerging markets? We don't know what he does with China. We don't know what view he'll take on India, for instance, in terms of some tariffs. But what do you think this huge move and this big win would mean for a market like India?
Yeah, look, I don't see a lot of read-through from the U.S. election. Maybe if they're really doing a lot more even on fiscal. I mean, but let's remember, they're already quite stretched. But let's say there's a little bit more. I'd say stronger dollar potentially, or at least not going down as much as we currently believe. Right, it's maybe somewhat supportive for the exporters, of course, IT. But look, I have a very different view of India. I held it before the election even. Right, so I did my numbers on India. This case, MSCI India. So I also remember when I was here on the program last time, and what I said was, compared to the fiscal 24, we're going to see earnings growth, not necessarily negative, right, but sort of almost cut in half, right? And the market needs to respond to that. And by now it has, right? So the dip is here. It's a fairly sizable one by now, right? And when I just did my numbers recently, what I noticed was there are some sectors in India, and these are big sectors, especially the financials, things like consumer, potentially also IT, where in the next fiscal year, so 26, and it sounds far away, but it's really sort of starting mid next year, where we're already moving into that, when actually the negative effect or the pricing effect on margin reverses. So as much as I thought, okay, the markets are nifty, MSCI India, they have to respond negatively in a sense, or they have to correct. We have that correction now, and now we're 6 months away from a period where I think then in the upcoming fiscal earnings growth re-accelerates to some extent. So in other words, I think for investors, whether it's global or whether it's directly in India, it is a good time to start to positioning for that. I can easily justify over 10% upside on a 12-month basis. So yeah, much less to do with the US though.
Okay, so a 10% upside possible in the Indian market over the next 12 months. That's your view right now as earnings start recovering, right?
Quite possibly a bit more than 10 even.
Okay, all right.
All right. Hi, good morning, gentlemen. Good to see you. And Dhruv, from someone who has just come out of the phase that you're in, I'll tell you what, it only gets better. Those kids, I've got 2 little ones at home, and it gets better. So don't worry, mate. But let's focus on the markets then, Dhruv. Trump is likely to help the domestic economy out there. And that could lead to a broadening of the US rally that we're seeing. As of the last 12, 18 months, it's been more of a few stocks that have moved up. Now, you saw overnight, in fact, the Russell 2000 outperformed what the three frontliners did. How much of a risk is it to the rest of the globe? Because the US party could continue, but it could come at a risk of some of the emerging markets. So your view on the Indian markets?
Yeah, so interesting here. There was a lot of ways to kind of play global market broadening, right? Like to your point, there was only a few big stocks working in a big way is what it really felt like for the last 2 years. Then you started to see a little bit of that value trade, not just in the United States, but globally kick in. And honestly, that benefited Europe, that benefited emerging markets to some degree. So our global equity view right now is Trump and his domestic focus. It probably does help the US. It probably helps sustain momentum, at least near term. Him being in office, the Republicans with a more aggressive mandate as they take the Senate and potentially the House, does help US small cap. Where it probably hurts the most is actually Europe ex-UK, in our view, and then in emerging markets, Brazil and China. So when we think about the Indian opportunity, it definitely looks better to us relative to Brazil, China, even to some degree South Korea as well. So when we're thinking about EM positioning, we don't want to think about broad positioning. We want to be a little bit more selective in a country like India that may be able to withstand a higher dollar and a little bit more, maybe not just a little bit more, but more trade uncertainty in the world. India sets up better to us than many of the other emerging market countries.
You know, Drew, I think you hit the nail on the head. This is exactly what I was sort of grappling with in my mind. Because till now, for foreigners, emerging markets have been one big basket, right? You allocate money to an EM fund and some of it makes its way to India or Brazil or wherever. Do you see that changing just from a money flow point, not just your own call, your house call, but in general? Will emerging market funds in the near term stop getting the money as people get narrower with their strategies, which means that in the near term, there will be a reduction in the flows coming in, right?
So it's funny you say that because you started seeing people break this out in Trump 1.0. So back then it was kind of EM and it was either an offer on trade. Then you started seeing factors get more popular in some of the ETFs where people were, let's say playing dividends or playing minimum volatility expressions in emerging markets. And then when Trump 1.0 happened, we started seeing people break apart China. Now we're starting to see more active management come into EM as well. So while we don't have these very aggressive kind of all-in flows on EM, you're going to start seeing more selectivity. So for every dollar that goes into EM, it's not going to be as directed towards China, which was a bigger weight in the MSCI EM index, especially at that time. You may see more of that flow go to other countries. So yeah, there may be fewer dollars going to EM, but you might see more dollars going to specific countries that can withstand, some of the concerns, people have around Trump 2.0.
All right, no, that's we'll take it. Thank you very much, Drew. Great to have you with us here. Hartmut, appreciate you being with us here on CNBC TV18 as well. Thank you very much, gentlemen.